And so we believe very, very firmly that anyone can be an entrepreneur.
If you just bought and held the top 10 stocks from today and you held them for 10 years, I guarantee you'd more than double your money in the 10 years.
Wow.
Hello, everyone. Welcome to another exciting edition of this week's School for Startups Radio Wealth Within Update. We're very excited to welcome back our resident guru, Dale Gillham of Wealth Within. Also, make sure you check out his book, Accelerate Your Wealth. It's your money, your choice. Dale, welcome. How you doing this week?
I'm fantastic, nice and rested after having a couple of weeks off, travelling around and sitting on a tropical island with my feet up, reading books and doing nothing much. So it was nice, but it's good to get back into the market because it's been quite interesting.
Yeah, I wouldn't know. The market has disappeared in the United States. We are talking about one thing and one thing only, and that is the impeachment. And I did a little exercise, Dale, to test this. I was watching one of the two big, business channels, continual business channels, not a news channel, a business channel. And the channel I was watching went an hour and 42 minutes without mentioning the market. They're just not paying attention. In America, the market has disappeared in the news. It's not relevant. Even the business channels don't cover it this week. What does that tell you? I mean, so anyway, we're obsessed with impeaching the president, whether you want that or not. That's what you're going to learn on the market channels this week.
Yes, that's one thing that annoys me with television stations. There's some sort of natural disaster or something, and that's all they cover for hours and hours and hours. They're not broadening out that news. But yeah, I mean, obviously impeaching a president is big news, but you probably don't need to go on it all day long every day, do you, for a while?
Well, there's no new news. That's the problem. They just keep saying the same thing again and again and again. All right, so let's turn to what did happen. The market, I think, validated you quite a bit. The market was down a teeny bit, just as you suggested the last time that we talked. But all of the fundamentals seem strong. The big data that came out this week was the jobs report. About 140,000 jobs, a little less than we expected, but still a very strong number.
Yeah, it was. I think it was down. I think it was 168,000 the month before, so it was down a little bit. But economists were expecting even down to like maybe 120,000. So it was sort of in line with what they expected, But the Dow, obviously, it reacted last week to some news, and it was down, I think, only closed down around 0.92% for the week. The S&P was down about the same. I mean, at one stage, though, they were both down around 4%, but it is going down to what I expected. I do think we've got probably more bearishness to happen this month, but nothing too major. But because it really is, there's sort of bad news on the US market, but it's nowhere near as bad as what it could be. But there are some really, really positive signs. I think there's a lot of reasons for your listeners to be very optimistic for the coming year or so in terms of where the market's going to. But right now, I think the Dow it's probably going to go down to somewhere below 25,000 points, which is probably another 6 to 10% maybe over the next 2 to 4 weeks, and then go bullish through to Christmas. So that's sort of what I'm thinking at this point in time. So over the next few weeks, roughly a little bit more bearish. But really the jobs losses were mainly retail and manufacturing. So that could be that sort of flow on from the China-US trade deal, etc. So that's where most of the job losses or the jobs haven't been created. Unemployment's still looking not too bad. It's looking around 3.5%, which I think is the lowest since 1969. So it does look really, really good. But the other important figure last Friday was the wage growth figure as well. So not just employment figures, but also wage growth, and that's pretty much stagnant at this point in time. But it's causing, I think it's like 1.5% over the last year or so. It's grown, so not very much, quite stagnant, but they're suggesting that's causing the softening in the US consumer spending, and that continuing losses in manufacturing jobs really is, as I said, an impact of Trump's tariffs and trade war against China and how that's really starting to take effect. But It's not taking much of an effect, and that's what the exciting thing is to me. I think we're seeing some really good signs with the US market moving forward. And I've done a recording, which I'm going to tack onto the bottom of this for those people who want to go to my YouTube channel, Wealth Within TV, of talking about the Dow and what I think it's going to be doing, because it's doing the same thing as it did a few years back. It went sideways for about 2 years, the Dow, and then it broke up and did very well. I think it's going to do the same thing at the moment, is whilst it's been going sideways since I think January 2018, I think we're going to start to break up because the inflation rate's due to be pegged at around 2.5%. I think that's what the economists are looking for in the coming couple of years, and that's not bad from where we are at this point in time, but it does look good.
All right, so with America so distracted, you're predicting a 4 to 6% fall here in the next 2 months before we get ready for the Christmas run. I have always had a theory that the market exacerbates itself. You see it fall 2%, and that makes it fall another 2% because people are reacting and trying to get out before the bottom falls out or whatever. If people are not paying as much attention and distracted, do you think the retreat might be a little smaller, or does my theory make any sense, Dale?
Yeah, it does, because basically the market runs on fear and greed. That's how it works. You know, people are fearful, they stay out. If they're greedy, they get in. Simple as that. Lower interest rates mean people have more opportunities in the stock market. They get dividend yields, they get some income coming from that. So right now, interest rates are still pretty good in the US. Obviously, there was like 9 or 10 rises in a row. We've had one small cut at the beginning of September, so nothing too much. The Fed's got a lot of room to bring down interest rates if they want to speed up the economy, so there's plenty of good signs there. At this point in time, I don't think they need to, but people they either panic or they're greedy, and right now nobody's greedy. So when we're seeing downward moves, we're seeing that panic, and there's an old saying, the amateurs buy at the top and sell at the bottom. So when you see a market move down, this is just the big end of town selling off a few stocks. But then what that happens is the people that aren't really educated, people who haven't read my book, will go, oh, I'll just get out now and wait for the bottom. And that pushes that last move down into a low, only for the market to find support and move up again. So that's what I'm expecting, is the market will have another move down in the next couple of weeks. And then what will happen is the mum and dad investors will start to panic, thinking, oh, the market's going to crash. They'll sell out. There'll be an exhaustion. It'll hit a bottom and then it'll start taking off again. And that's what I was saying, you know, that around that 6-7% from where it is right now is not much. It's just hang on to it. Hang on to the good stocks. Don't get into those bad stocks. But that's why I always promote using stop losses on your stocks, because that will help you protect your capital. That's the number one thing you should always be doing, is protection of capital.
You've taught us that, Dale. That's one thing we're hearing every week, and so I just love the repetition. It's good for us. I know that one of your favorite books is really being validated by some of the things we're seeing right now. Tell us about Triumph of the Optimist, 101 Years of Global Investment Returns, and how this has shaped your philosophy.
Well, yeah, it's a book put out by Princeton University Press, and I've had that more than a decade, and it just blew my mind when I saw it. And basically the premise of the book is looking at world markets and looking at what markets have performed, and doing a lot of research and statistics. That's also come out and been validated by other areas of the financial services market. So the same research has been conducted by other areas, coming up with exactly the same answers. But if I said to you, what was the best performing market in terms of growth over the last 100 years, what would your answer be?
Ooh, you're going to catch me looking uneducated. I think we would have to pick a market that went from the absolute basement to world domination. And in the last 100 years, China would fit into that category. I think maybe Japan. I think you're going to say, well, it could be any place that had 100 years ago not much economics and now is a superpower. So you could even put Australia in that group. I know you'd like to do that. Those are my guesses. I'm picking somewhere in the Pacific Rim.
Okay, well, you're right with Australia. So according to Triumph of the Optimist, now Triumph of the Optimist was released in 2002, the original. They have updated some of that since, and it's changed a little bit. Now it's South Africa's number one. So another country that's come from nowhere, so to speak, over the last 100 years. But when it was released in 2002, it said that it researched 111 different countries with stock markets. So the value was around about 36 trillion, so it'd be more than 100 trillion right now. And some countries had more than one exchange, like the US has the Dow, the S&P, the NASDAQ, it just goes on. But in terms of capitalization, you're pretty good. So in terms of market capitalization, the US is about half of that. You've got Japan, UK, France, Germany, Canada, Italy and the Netherlands in that sort of that level, then Switzerland, Hong Kong. Now, that was your top 10 in terms of capitalisation of the market. Australia was 11th on the list, so you weren't too far off on that, so you can give yourself a pat on the back. But as I said, USA is roughly about half of the market. Now, over the last 103 years, or the 103 years that was studied, Australia averaged 7.4% versus the USA 6.3%. That's the annualised percentage return. Now, Australia was number 1, Sweden was number 2 on the list, South Africa was number 3, USA was number 4, and Canada number 5. So not too bad guess, Jim. So that was back in 2002. Now, as I said, I believe South Africa's number 1 and Australia went to number 2. But it's still really good. As I said, I was very impressed with your guess there.
But China's not on the, I would have to think China's on the list more than just Hong Kong.
Yeah, I think China probably would be. If the last time I saw the figures was about 2 years ago, I believe. So I'd need to start researching what it is now, whether they've updated their research. But you'd think China and possibly India would start coming up underneath that as well, because they're obviously very growing economies, both with large stock exchanges. And the Indian stock exchange is huge. It really is well traded by naturalized Indians. I often get emails from Indians saying, I want to trade this, I want to do that. So they would probably move into it. But part of the reason why I brought this up right now is often when the market's bearish, you get the big end of town telling everybody to invest overseas because there's more opportunities overseas. And it doesn't matter whether you're in Australia or in the US or the UK or wherever you are, the big end of town keep pushing you to go into like exchange traded funds in overseas markets or world markets, saying you got more opportunity. And the research that the Triumph of the Optimist did tells you that's absolute BS. You're better off staying in your own market, trading your own market, because you know it, you don't have currency exchange risks, etc. But I would expect over the coming months that we'd get a lot more. Go and invest overseas. That by my expectation is. But your market's still really great. As I said, it's half of the world markets roughly, and still performed really, really well over the last 101 years. But there's another chart I'll talk to you about another time where it shows how Australia and the US track. Last week I actually did it on my live YouTube show that I do for Australia, but I talked about this, and I talked a bit about Triumph for the Optimist and how the US and Australia get out of sync and then they get back into sync. And it's quite interesting how markets ebb and flow. But that happens, like the US could correlate to lots of other markets. So it's quite interesting research that your listeners might like to get onto our YouTube channel and have a look at that from my live show last week.
Well, we will do that. I think we actually link to both shows now on our TV page on the School for Startups Radio website. So go there and get all of these videos and Dale's other videos as well from Wealth Within. Dale, we need to sign off. I think our time is about up. Microcosm this week, what do you see happening this week? We've talked about the larger trend this week, though, just a down week, 1%.
Yeah, I think the market will go down. As I said, I'm expecting a little bit of a rally at some stage in the next couple of weeks, but I think generally down over the next few weeks. We might have a few days up before another fall, but something will happen to make the market fall. Not sure what it's going to be, but that's my prediction over the next few weeks down.
Well, we haven't had any bad China news recently, so maybe that will be it. So,
Quite possibly.
All right, Dale, thank you so much for our weekly update. We will talk to you next week. And always remember, you can find more about Dale and his work at Wealth Within.
Thanks, Jim. Take care.
Please remember that this report is an educational tool. While Wealth Within holds an Australian financial services license, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Now, wasn't last week exciting with the market falling quite heavily on a couple of days there before coming back later on in the week? And as a trader, I love weeks like this, but as I do understand as retail investors or retail traders, a lot of people get nervous and they panic and they have a lot of terms like, wow, isn't the market bearish, or did the market melted down? They give me all these sorts of terms. And to me, if you're panicking about the market right now, if you're seriously worried about your stocks and the market right now, that is a huge sign that you don't know enough and you don't understand the market very, very well. So here, from my book, Accelerate Your Wealth, it's your money, your choice, get it. You'll understand the market a lot better and you'll learn to enjoy times like what we saw last week. Now, you can get it in bookstores across the US or get it online from Amazon. So get your copy of the book, and it really will help you sort out understanding how to manage your portfolio and really avoid these types of weeks or not worry about them, so that you can put your feet up, sit on the beach and drink pina coladas rather than stressing out and biting your fingernails. But let's get on to the charts of the Dow Jones. I want to take a little bit of a different look today and just show you what I'm talking about here. So on the screen right now, you've got a chart of the Dow Jones. Now, looking at that, you can see here we've got this big movement from January 2018 right through to today. And you can see this whole move is really a sideways-ish type of move. So if I go here and draw my line there, you can see the current price. If I drag that out, you can see the current closing price of the Dow is pretty much what it was way back in January 2018. So nearly 2 years, the Dow's gone almost nowhere, and the S&P 500 is not much difference. That's what I was saying the other week, that the market has risen very, very little over the last couple of years. Now, simply because what happens with markets is they move from a low and they get into what they call disequilibrium, or they break out into volatility and they make a new high, and then they distribute for a while or get to equilibrium where buyers and sellers tend to agree, because markets run too fast, just because human nature is just exactly what it is. If we're greedy, we run fast. If we're fearful, we run fast the other way, and that's really what happens. So markets overheat, then they cool down a little bit, then they go again, and so we're going to wait to see what's happening. At this point in time, we've had a cooling down period of a couple of years. That's why I still think the US market has further to go. I think there's at least one more run, a bullish run there. And we can saw here right through from this period here back in November 2014. If I expand that up for you, you'll actually see what I mean. A very, very similar type of period here where the market really just went sideways for quite a period of time. If I put my horizontal line on it, you'll see exactly what I was talking about here. So here, what's that? November 2014, and here we have that's July 2016. So again, 2 years where it ran sideways, up and down, all over the place. So all I'm expecting is the same thing, is the market's going to wash out a little bit here, and then it'll take off and it'll have a new bullish run. Now, how far can it fall, I hear you saying? And a lot of people are really a bit worried about it, and some people say to me, should I sell out all my stocks and come back out in when the market bottoms? And that's not a really solid strategy. That's why I teach you in my book, Accelerate Your Wealth, to set stop losses. Only ever sell stocks that tell you that they're having a larger fall. Just to sell out stocks to buy back in later on, quite often you'll sell them now and it might only bottom in 2 weeks' time, and then you'll be buying them back at a higher price. So unless you can understand getting your timing right, then you're going to muck that up. So that's why I suggest you using stop losses such as the 15% stop loss that I talk about in my book. So right now, looking at this, we're seeing, if I put a little tool on here, I'm expecting the Dow to go sort of down to below that sort of 25,000 or 26,000 points down here. So I'm expecting it to go somewhere between 25 and 24,000 points. Now, it's possible that it's going to hold where it is, but I doubt it. I think we're going to have a bit more of a washout here in October, right through sort of to mid to late October, possibly into the last week of October before we see the eventual low, and then I think it will take off. It could happen a little bit earlier, like mid-October, but I'm thinking the last week of October, and then go from that point in time. So at this point here, that low there at 25,743, I think if we see this week we start going below that, then we will go below that 25,339 and get down into this sort of area over the next 2 to 4 weeks. So expect a little bit more volatility, but don't stress out. If I use my cool little tool, you can see from the current close here, Down to that level is 5%. Down to this level is 7.5% from where it is. So 5 to 7.5% is nothing in the big scheme of things. Now, to me, as I said, just look at your portfolio, make sure you've got stop losses on the stocks that you own. If you don't, make sure you put some on, and don't panic. Just sit back and relax, because the market will go bullish. Definitely not crashing. The US market, as you heard with Jim and I talking a little bit earlier, is looking really, really good, or nowhere near as bad as what other people are telling you. So at this point in time, the Dow looks great. Now what I want to do is look at the stocks in the S&P 500. Now I'm going to look, I've got some watch list here. Now this is the top 20 stocks in the S&P 500. I want to give you some thoughts on that. Now looking at this, you're seeing in the last year, so this is calendar year, so from 1 January, MasterCard's made 45%, Apple 43%, so you've got some great gains on some of these big stocks. These stocks drive the S&P 500. Now, a lot of people have been asking me about ETFs. Now, I know I have spoken with Jim Beach about ETFs and are saying that you shouldn't go into them. Index ones you should stay right out of. Just buy the top 10 stocks, so pick 10 of these 20 stocks in the S&P 500. They're the top stocks in the S&P by market capitalization. Pick 10 of these, you'll outperform any ETF on the planet, any index ETF on the planet, and you'll save yourself cost, you'll have a lot less risk, and you'll make some income as well. That's just growth that you're seeing on your screen. You're not actually seeing dividend income on that as well, so you'd have that along with it. So, but looking at the S&P top 100 stocks, now this is the top 100 by market capitalization. I put this list together about 2 months ago, so it should be still very, very relevant to that. And we can see the 1 year return again from 1 January, Dow DuPont up 89.54%. Now, some of these stocks are up these big returns for the year simply because they were so bearish. Now, Dow DuPont was. If we go and have a look at the chart of Dow DuPont, you can see here it was, I've got to fix that chart. There's a huge big gap in it there, but it's been quite bearish, but it has been bullish, as you can see there, 89.54%, but my data's out a little bit, but it could still give you some opportunities. I mean, obviously, if you're coming off a lower price, so this is May down here, and obviously there's some issues here. There's something happened at this point in time. I can't quite remember from there, but there's a big move there on Dow DuPont, pushing it up to there. So there could still be some opportunities on that. Celgene Corp, let's have a quick squeeze at that. Have a look at that. Nice, beautiful move up. Now's the time to be looking at getting into these sorts of stocks, because had been very, very bearish right through from this high back in October 2017. So it's now moved off the bottom, and proven it's starting to move up quite nicely. So look at these sorts of stocks. So sometimes I'll look at the worst stocks on the marketplace, looking for ones that had these big falls and they're starting to turn around to put on my watch list for moving forward. But then I look at some other ones. Here's your MasterCard up 45.72%. A little bit different story, isn't it? Been quite bullish through here, but it could be able to get into the stock cheaply at the moment if the market does fall away a little bit and MasterCard does fall away. Apple's looking really, really good. You can see here Apple's about to break through an all-time high. If I go into the monthly chart, you'll see what I'm talking about here, but I think Apple's got more to go. Now let's look at the worst performers this year. If I just click on here, you'll start seeing these are the worst performers since 1 January. So we've got 9 months of data on here, and you can see 3M, a big stock here, and has not done very, very well. And if I expand that out, you can see here why. Looking at that, it's fallen away, but eventually 3M will find some support and start to move up. That's what I was talking about a minute ago, is you stick these on your watch list for when they do start to turn, because 3M, great company. Pfizer down 17.69. So let's put that on a monthly chart, and you can see here Pfizer fallen away. Again, I need to update my data on this one a little bit. But it could be finding some support where it is. So I'd be looking at Pfizer on there. Altria Group, I actually do like Altria Group, and you can see here what it's been doing. It's been really, really bearish for quite some time here through from January last year, but it could be finding some support. So looking at these for possible turnarounds. Schlumberger was one I talked about a little while ago, and looking at that, that could be a turnaround. And if we look here at this chart, if it stays above these lows here, it should start to move up. And if it gets above this sort of $40 mark here, then it would be a nice medium-term uptrend. But there's some great ones there. You know, Caterpillar, Lilly, Eli. There's another good one. Bristol Myers Squibb's another good one that I'd be keeping my eye on. Amgen, ExxonMobil, I'd be keeping my eye on. Berkshire Hathaway there. You know, the BRKB shares. Only up 1.91%. That's possibly because the market's been a little bit more sideways-ish. But if the market takes off, those will take off. And Netflix only 1.92%. I'd still do like Netflix as well as a stock. And you might be starting to see the turnaround here. So have a look at, these are the times when the market's a bit more volatile, a little bit more bearish. These are the times I plan for that next period, that next year. So that's why I look at these sorts of watch lists and say, okay, what's been great, what's not been great, what do I need to do, what stocks should I put on my watch list for down the track? And it's like planning, what am I going to put into my portfolio later on? I just don't look at a newspaper and go, oh, you know, somebody talking up this stock, let's go into that. It's about planning your portfolio, balancing out your shares, balancing out your position sizing, using your money management risk. And if you're not sure how to do that, again, just buy my book, Accelerate Your Wealth. It's your money, your choice, on Amazon, in bookstores. Get it. You'll really understand the marketplace after you read the book. But that's it for me. If you do want me to have a look at a stock for you, a US stock, stick it down there in the chat. If you've got a question on anything for me to cover with Jim, or just for me to answer for you live on this, then I'm really, really happy to do that. But that's it for me for this week. Good luck, good trading. Take care.